Good morning and welcome to the AFA panel on geopolitical fragmentation. I'm going to moderate this panel. My name is Yuriy Gorodnichenko. I'm from UC Berkeley and Ukraine. And I must say that when you choose a topic for a panel, you have to plan quite a bit ahead. You have to be thinking what is going to be a good, interesting question in about a year. And given how complicated the world is, it's always very difficult to forecast. Right. So I was thinking, what can be a great question to discuss and what would be a question that deserves our attention in a year. Now, my thoughts were obviously clouded by, what was happening in Ukraine, the barbaric invasion by Russia. And, I had a sort of a first-hand experience of what is happening in terms of economy, where we have disruptions of trade flows, energy flows, finance. And you kind of wonder if this is a local thing or is this going to be a global trend. Obviously, at the time when I was proposing this panel, I saw clouds on the horizon, but little I knew that those clouds are going to be much, much bigger and much, much darker than about a year ago. And so I was very happy and very upset at the same time. I was upset because for once my bad forecast turned out to be true. I often criticize rational expectations as not being a particularly useful framework, but now the irrational forecasts turn out to be correct. I was also very happy that three wonderful speakers agreed to participate in this panel, and I hope they will enlighten me and others in this room about this very important matter. We have Maurice Obstfeld from the Peterson Institute, my former colleague at Berkeley, Philippe Lane from the ECB, and Markus Brunnermeier from Princeton University. I'm sure all of you want to hear what they have to say, and we will start without further ado with Maurice Obstfeld. Maurice.
Well, thank you very much, Yuriy. It's a great pleasure to be here in sunny San Francisco, and especially to share the dais with my colleague Yuriy and my old friend Philip and my Peterson colleague Markus. And I'm going to talk about guns and butter. What else to talk about at the annual meetings of the American Economic Association? The phrase guns and butter is thought to have originated with a very important figure in the history of economics and political populism, William Jennings Bryan, who resigned as Secretary of State from the Woodrow Wilson administration because Wilson was prioritizing military expenditures in light of the ongoing hostilities in Europe, which Wilson thought might call on the U.S. for some military response at some point. And he critiqued Wilson for putting guns before butter in 1915 when he resigned. In 1936, the German Reichsmarshal Hermann Göring put a more sinister turn to this phrase by saying, "Guns will make us powerful, butter will only make us fat." And what he was getting at here, of course, was the Nazi war machine's military buildup, but also the activities of Germany in basically withdrawing from multilateral international relations, repudiating its debt in favor of regional arrangements in Eastern Europe, which were intended to enhance its power, its military power in Europe. Now, as economists, when we say guns and butter, we actually go back to the sanitized version that was introduced in 1948 by Paul Samuelson, who, in this famous picture of the production possibilities frontier, said, for dramatic purposes, we can concentrate on the famous pair, guns and butter. But he explained that, don't think of this in terms of military action at all. Just think of these as a choice between two commodities like food and clothing. It's no different. So whenever we teach Econ 1, we talk about guns and butter. But in fact, economists for quite some time have been interested in the more sinister implications of this. What the Germans did in World War II and in the lead up to World War II, and also nowadays in the world where we can see in Putin's Russia the attempt to distort the economy into basically a wartime economy, into a war machine at the expense, we think, of economic welfare. Probably the first book in the field of geoeconomics was Albert Hirschman's book, National Power and the Structure of Foreign Trade. He wrote it across the bay in Berkeley. That's University of California Press. And Hirschman basically explored the German approach during the interwar period. And he talked about the guns-butter trade-off as subjugating a certain vision of economics, the idea that countries mutually gain when they engage in trade, to a different vision of international economic relations as zero-sum economics with a political overlay. In the view of someone like Adam Smith, he wrote, there are mutual gains from trade. In the views of the mercantilists, trade is a zero-sum game, but you can understand their view if you marry the idea of economic advantage to that of political advantage. When you have restrictions on trade, when you have a breakdown of cooperation, everybody loses, but the countries that lose relatively less may be politically more powerful relative to their trade partners. So that brings us to the present and the incoming administration. And my thesis is that this new administration has announced pretty clearly the intention to move to a different point on the guns-butter trade-off, by which I don't mean simply spending more on defense, but by which I mean behaving within the global economy in a way that might increase U.S. power in some sense, but at the expense of global cooperation and global welfare, and indeed, perhaps national welfare. A lot of the chatter has been about tariffs, and this is reflected in measures of economic policy uncertainty regarding trade. I'm showing here the Caldera et al. Measure of trade policy uncertainty, and you can see how it spiked during the last Trump administration, how during the Biden administration, even though this was not an administration at all friendly to trade, trade policy uncertainty was lower, and now we have a renewed spike to unprecedented, at least since this index was devised, levels of uncertainty. And of course, the authors of this paper showed in the JME piece that introduced it, the measure, that trade policy uncertainty has a noticeably negative effect on investment. Where we're going is a little bit ironic in the sense that during the campaign, the president-elect ran entirely on butter. And the motivations for tariffs that he presented were the long-term decline in manufacturing, which I show here in the left-hand chart with Fred data, and also the trade deficit of the U.S., which has increased over time, even relative to GDP, which is long-standing, and both of which Trump viewed as evidence of the rest of the world stealing from the U.S., stealing treasure, stealing manufacturing jobs, something that would need to be corrected by tariffs. But he presented this as an economic argument, not as a political argument. But tariffs, I would predict, can and will be used as guns, not just to increase our supply of butter. Congress, the new Congress, which starts today, will pass a fiscal year 2025 budget in March, and I'm willing to bet that this will include a baseline level of legislated tariffs, which will be put in place to cover the budgetary shortfalls due to the many tax cuts that Trump and Republicans have promised, in particular the extension of the 2017 Tax Cut and Jobs Act. These are not going to put much of a dent in the trade deficit, which is mostly a macro phenomenon, nor are they likely to enhance manufacturing employment much. Manufacturing employment is on a solidly declining trend as a share of GDP. This is a regularity that applies to all countries, whether they be deficit or surplus countries. In fact, Bob Lawrence has a wonderful new Peterson book on this, which I would recommend to you if you want to study this issue. But tariffs will also be deployed opportunistically for non-economic as well as economic goals. And here there are existing presidential authorities which can be used, possibly stretched, but used to justify a range of actions. The Biden administration, I think, is culpable of putting us on this slippery slope by not unwinding Trump's earlier China tariffs, by flaunting WTO rules. But that was a bunny slope, and now we may be hurtling down a double black diamond toward something very different. Now, what are examples of things where the administration has already expressed, the new administration, the incoming administration, concerns? Well, famously, President-elect Trump threatened Canada and Mexico with 25% tariffs if they don't tighten up border restrictions and do something more to impede the flow of fentanyl across borders. Now, there is an agreement with these two countries, the USMCA, which Trump himself renegotiated, which passed Congress with bipartisan support, and which is contravened by these threats. Nonetheless, the threats were made and could be implemented. Trump threatened the BRICS countries with huge tariffs were they to proceed with plans for a so-called BRICS currency, something that is unlikely to have much purchase in any case, but this is an example of a geopolitical threat really against the sovereignty of other nations. Trump has expressed a desire to acquire Greenland, and some in his camp think it could be merged with Alaska. An interesting idea. But could Trump threaten huge tariffs against Denmark if they don't agree to make some concessions with regard to Greenland? Well, why not? Another area that I think we're going to hear more about is the new EU-Mercosur agreement that the European Commission has negotiated with the Mercosur countries. This is controversial within the EU, although it is likely to pass. But if you think about what it entails the possibility of trade diversion away from the US. So, for example, Brazil, a Mercosur country, the biggest Mercosur country, runs a bilateral deficit with the US, something that Trump would look favorably upon. Might he threaten the EU or the Mercosur countries with huge tariffs if they proceed with this deal? I don't think that's at all out of the realm of possibility. Now, if you think I'm imagining this, listen to the interview that the next Treasury Secretary, Scott Bessent, gave in October to a conference of the Simplify Asset Management, where he mused that tariffs should actually favor like-minded members of a security zone, which might be a zone that uses the dollar as a reserve currency. He suggests establishing green, yellow, and red classes of trade partners. He gives as an example India as a yellow trade partner because it has been trading with Russia, and suggests that India could move into the red zone if it continues. The green partners are those with, quote, shared values, shared economy, shared defense, shared currency goals. And in my view, shared goals in practice would mean US goals. There's not going to be a negotiation about whose goals and values are at stake in the imposition of US tariffs. And as the tariffs fail to deliver the butter of a lower trade deficit and more manufacturing jobs, I think attention would turn to a weaker dollar, which is something that the Trump team has also proposed. And just to highlight the contradictions in the economic proposals, tariffs based on any economic model we have lead to a stronger currency. The currency appreciates. So this is probably one of the reasons why we see the dollar appreciating in recent weeks. There are other reasons, but it's also a reason why tariffs are going to fail to deliver on the trade deficit of manufacturing, because there's at least a partial offset from the currency. But once attention turns to the currency, it raises the issue of how to actually depreciate the dollar. What is the role of our trade partners? What pressures can be brought to bear on them? The new CEA chair designate actually wrote an interesting document back in November, about a month before he was named, called A User's Guide to Restructuring the Global Trading System. And keying off of Besant's remarks in October, he includes this list of issues on which tariffs could be used punitively. I mean, I think he would say persuasively, but I think punitively is a better word, against trade partners. And they range from economic issues. Does the nation apply similar tariff rates to their imports from the US as America does on their exports here? One could add bilateral surpluses with the US. They range from these economic issues to questions like, do the nation's leaders grandstand against the United States in the international theater? And if they do, slap tariffs on them and get them to stop. And there's just a range of other suggestions of how the U.S. could pressure its allies to help implement its own domestic policies. For example, using tariffs to persuade foreign countries to intervene multilaterally to weaken the dollar, or suggesting that foreign trade partners hold their dollar international reserves in the form of ultra long-term bonds, because this would actually be a form of QE which reduces the premium at which the Treasury has to borrow and could be helpful in facilitating the U.S.'s fiscal goals. So this is a whole new world of I would say, geopolitical fragmentation. Obviously, all of this is in violation of most favored nation principles that were developed to avoid some of the disruptions that occurred in the interwar period. Now, these wishes that I've listed, I don't want to imply that these are not things that all governments basically would desire. And in fact, we've seen the Chinese government actually take actions like this when the Australians suggested that there needed to be an international investigation of the origins of COVID. The Chinese banned imports from Australia. So That's something we looked on with horror, but now what's being proposed is that sort of approach on steroids being practiced by the U.S. This is totally contrary to the post-war settlement that the U.S. championed. The whole philosophy of building post-war institutions and a rules-based system 8 decades ago was that global prosperity and economic predictability are in everyone's economic and political interest. A prosperous world would be a more peaceful world, and even the hegemonic power of the US would benefit if there was enough butter to counteract the drive for guns. But over 80 years, this program, which in some respects has worked marvelously well to lift a huge percentage of the world out of poverty, has also had unintended side effects, particularly in the richer countries. It's been a source of disruption, which has added to the probably bigger disruptions from technology. And history tells us that as the balance of international power changes, in part due to economic development, the goals, the methods of countries change. Some historians believe that the development of Russia prior to World War I into a burgeoning industrial power helped destabilize Europe in ways that helped lead to World War I. Of course, Russia was relying on trade and capital inflows to finance this development in that period over a century ago. Now, if you listen to voices on the president-elect's economic team, they basically deny that favoring guns over butter, using the kind of tools that I've laid out, will actually be economically costly. So the denials range from, oh, foreigners will pay for the tariffs, to tariffs will lead many workers to come off the sidelines and populate new factories, leading to a new era of prosperity. There's also a tendency in the administration to valorize production over consumption, and to argue that, well, it's actually okay if we consume less because we want to be a nation of producers, not consumers. And that's a view that one heard also in the 1930s, in Germany and other countries. I would say that what we may see could be a return closer to the fragmentation of the 1930s, but the world in which we now live is one where there are vast new collective action challenges that really require international cooperation that will be much harder to maintain in a world of trade warfare. The climate crisis was not on the horizon then. Nuclear weapons had not been invented in the 30s. Pandemics were present. The 1918-1919 flu pandemic was not that distant. But in today's world of much bigger population, of greater encroachment on natural habitats, the threat of disease and pandemic disease is probably much greater than it was even then, and COVID is not an outlier. I'll stop there.
Thank you, Maurice. The next speaker is going to be Philip Lane.
Good morning. So as Yuriy said at the start, This session was organized a while ago, so it's what I'm going to talk about is reflecting the work of the Eurosystem, the European Central Bank, and the national central banks about the general topic of fragmentation. Of course, fragmentation has been in the air, definitely at the European level, since 2016. If you remember, we've had Brexit on top of the various trade policies that were introduced here in the US under the first Trump regime. So we've had this issue for quite a while, and of course there's new discussions right now. So what I want to do is show how we're thinking about it. And by the way, the slides I'm going to show you reflect a new report which just came out about 10 days ago or 2 weeks ago, which you can find on the ECB website, which many people were involved in developing. And just from a research point of view, there's quite a lot of innovations in how fragmentation was modeled in this report. And it was a nice example, by the way, of converting some academic work, for example, the work developed by Baki and Fari, but then modified and adapted, if you like, to also answer some relevant policy questions. And so let me say, what I'm going to talk about is really scenarios where the details of what exactly is done in terms of non-tariff barriers or tariffs is left to one side. The scenarios are really about the scale of the reconfiguration. So whether it's a non-tariff barrier or a tariff, it's delivering a sizable reshaping of global trade. So that's the way to think about it. Because, of course, I know there's a lot of interest also about how we think about different near-term issues, which will not take on directly here, and the charts should not be interpreted in that way. So the basic setup is to divide the world into 3 blocks. So essentially, there's a Western world, there's an Eastern world led by China, if you like, and then there's neutral countries. This is similar. Many people are using this UN voting pattern, but actually, one of the innovations in this work is actually now it's still built on that, but it also adds in, for example, where does a country buy its weapons from? So is it military supplier, Western, Eastern, and so on, which is relevant, and there's some other issues. Opinion polls about attitudes towards the West, attitudes to the East. So there's a range of things. But of course, there's nothing magic about 3 blocks. I presented this before, and some other people have discussed it. You can also think about finer disaggregations than 3. The report partly just says, okay, where are we right now? What's going on right now? And so part of this is based, if you like, also from looking at the trade data so far. But let me also emphasize, and again, this is where a central bank has the resources to do it, we're also doing quite a lot of surveys. So, you're not going to see necessarily in the trade data so far, which come with a lag, lots of decisions that have been made, are being made, but the firms will say, okay, here's what we're doing. And so in their planning, in their next cycle of where to locate production and so on, there's a lot going on, even if the trade data so far will not reflect it. In any event, when you look at the trade data, you do see already sizable moves in terms of the share of trade with the different blocks. So the left chart shows the Western blocks import shares, and you are seeing already before the pandemic, some degree of reshuffling. There's definitely more in the last 3 years. And if you look at that decline in the trade between the West and the Eastern bloc, of course, part of that is the sanctions on Russia. But there's also visibly a lot less direct trade between China and the US. You see also on the right, an important element of that is the differentiation between, if you like, sensitive products, and different parts of the world are sensitive about different products. So on the right, I show two cuts of the data. One is advanced technology products, and the other one is green transition products. And what you see here, is essentially striking the decline of direct trade between the US and China in terms of advanced technology products. But there's a big rise in European trade in green transition products for China, which is underlying the role of China in terms of those sectors. Okay, so here's an example where maybe it's not so easy to find in the hard data so far, but when you ask the firms, and these are from some of the main European countries, what you see here is quite a lot of firms are doing something in anticipation of a kind of trying to reduce their exposure to China. And so you see here, a minority of firms have actually already done something. So actually de-risking action is still, but it's not a small fraction. It's 20, 30, 40%. So minority, but still quite a lot of firms have done something. And there's more who are thinking about it. And then the right chart said, okay, if you've taken an action, what is the nature of that action? And of course, in a European context, it's partly domestic, but the good news is the EU is fairly solid. So a lot of it is trying to find other parts of the EU to act as a supplier. So very importantly, the single market of the EU, of course, it could more can be done, as Mario Draghi and Enrico Letta have emphasized. But there is a lot of kind of conviction that there is a kind of core free trade area for the European Union there, but also looking elsewhere. So one of the scenarios in the report is basically going back to this idea of critical inputs. So for some sectors, we know there's a concentration around the world of who is either has the raw material or who's the main refiner of those raw materials. And you see here the bubbles tell you size. You see here, of course, Europe is very dependent on China, very dependent on the US. But what I'm going to do is an example where what would happen if essentially, again, the design of what policy delivers this, but if the amount of those inputs from China were halved, and to feed that through basically an input-output table, saying, look, you simply have only half of the same supply of these critical inputs. And what you see here is essentially a fairly sizable decline in manufacturing value added across the different countries in the study. But again, it's selective. There's basically a quarter of the companies would take a really big hit, and then there's a little bit among everyone else. So you can understand the kind of political impact if you take a small amount of firms, maybe regionally concentrated, who are really hit by such a development. And also, when you look across industries on the right, it's going to vary quite a bit. And you can see here, for example, electrical equipment, it's more like a -7% median response. You also see the country variation is quite significant. So this is, I think, underlying Europe is a highly integrated part of the world economy, highly dependent on China for some critical inputs. Okay, let me go from that kind of reporting, if you like, or which is basically looking about what's going on now, what's a kind of a sectoral perspective, to go to macro analysis. So here, I think the team have looked at different scenarios. And again, to repeat, these are really embracing the multi-country, multi-sector models that have been developed over the last 10 years or so, which are now a combination of empirical work through input-output tables and the ability to run these models at scale to look at different scenarios. Let me emphasize, mild is maybe a misleading scenario here. So the mild scenario is rollback trade to the mid-1990s. If you looked at charts of the scale of trade increase from the mid-1990s, that's not small. But it is mild to complete trade ban. So the severe decoupling is a complete trade ban with between West and East. And then in the middle is, again, maybe a more plausible scenario, selective decoupling, where there's a full trade ban on, as you say, like some inputs, but not all inputs. And what you see here is, now all of these are, again, to repeat, big numbers. So when you're tempted by looking at the left chart to say, well, that's not a big deal, the mild scenario. But actually, that's big enough when we think about this, the gains from trade or other metrics. Losing 2 percentage points of world GDP is not small. Then you get the selective decoupling is more like 5, and then it's more like 8 to 9 with severe. So these are really big effects. Let me emphasize again, if you can read the chart here, one of the innovations in this project is to add an investment channel to the Baki-Fari framework. And this adds, because essentially the optimal capital stock also goes down when you have this fragmentation, so you get lower investment as part of the adjustment, which amplifies the effects. But of course, and this I think lines up with what Maury just said, which is everyone loses, but not everyone loses in the same way. And what you see on the right is essentially the US loses the least and China loses the most. And under severe decoupling for China, that's a 20 percentage point decline in GDP. And Europe is somewhere in the middle. So this ranks with this, who's more open, who's more involved in global trade, especially global goods trade. And this is where you get this significant variation. Now, of course, one reason why I'm here and we're talking about this is the inflation impact. And again, to come back, this is the scenarios. You have to be very specific when you talk about the inflation impact. And these are scenarios where you have these really big trade policy movements, which again, it's here, they just kind of happen overnight and then the model runs. Of course, if you were to think about it in real time, you have to think about anticipation effects, gradualism in the rollout of some of these policies and so on. But for the purpose of kind of thinking about the economics here, I think what it's very important to show here is the mild decoupling, which again is not that small, gives you a deviation from the baseline, but it's like 60 basis points. So compared to an inflation target of 2%, of course, we would care about that. But if you had a really big decoupling, then you would get a much bigger price shock. Let me emphasize here, and again, the value of doing a macro analysis. On the right is a lot does depend on how the economy responds. And the left shows you, well, a lot depends on the labor market. I mean, historically, the view was, essentially workers tend to absorb a lot of hits to their real income from supply shocks. But if you had a tighter labor market, maybe you would have a faster wage adjustment, so there'd be a bigger wage price spiral, if you like, and you get a bigger inflation effect. And the last chart on the right is just to emphasize, this is a lot bigger than what we saw in the pandemic. In terms of the scale of the supply shock, this is a lot bigger than the bottlenecks and the energy shock we saw in the pandemic. And again, at the same time, we do find it useful, and this report finds it useful, to try and think about the pandemic as one example of what happens indeed. Okay, in the pandemic, there's a temporary set of supply bottlenecks. Temporarily, there was a big disruption in global trade, but it's helpful to think about that on the left. And this is core inflation, so it's ignoring the direct effect on energy prices and food prices. And you do see there's pretty big effects across the economy when you have these supply shocks. And then the right is basically, Maury at the start showed this chart. There's various people generating these trade policy uncertainty and geopolitical risk charts. But actually, empirically, they're quite visible in the data. So empirically, what you do see is you do get, this is just an example of kind of an increase in geopolitical risk. So the risk itself, regardless of actual policies, the risk itself leads to lower trade and higher trade prices. So here I snapshotted There's a lot more in the report, a lot of work I haven't emphasized in this presentation, so I'm just advertising you should look at this report. But what I would say is maybe, I think some of this is straightforward. From our point of view, let me emphasize, because trade data is so backward-looking, we've already done for the last couple of years on an ongoing basis to really monitor the supply chain quite carefully, to be really looking and talking to firms about what they're seeing in terms of upstream pressures, for example, in terms of their supply chains. I haven't talked here about, let's imagine over some period of time there is fragmentation and we live in a more fragmented world. If we are in that more fragmented world, one of the exercises the report does is say, okay, let's take the shocks of the last 50 years, run it through a model where we have a lot more fragmentation, and essentially you're going to get more inflation volatility. The kind of elasticity of the world economy has absorbed a lot of shocks in recent decades. If that world economy is less elastic, on top of everything else, you probably will get more inflation volatility. So we're very much, looking at all of these issues, and then going back to methodology. I think there's a happy coincidence here that a lot of the work in macro, which is moving towards heterogeneity and along all dimensions, is really important in order to uncover the kind of mechanisms by which fragmentation works. So let me stop there.
Okay, so we will continue with Markus Brunnermeier.
Thanks a lot, Yuriy. It's a pleasure to be here on the panel with Yuriy, Maurice, and Philip. I will talk about geoeconomics, resilience, about choke points, and the global safe asset implications of geopolitical fragmentation. If you look at the geopolitical shift we're experiencing, there's first the technological shift, which occurs already for some decades, that increasing returns to scale become more and more important. So that means market size matters. And the answer was, before the fragmentation, is that you can be a small firm, but you can, have a global market to yourself. You can specialize more and more and exploit essentially increasing returns to scale. And of course, that, this global market size, even for smaller companies, might go away. So we see a shift in the world order. We started before the fragmentation. We had a common framework, very much based on multilateral arrangements, rule-based. And we moved to a world where everything is bilateral, much more pronounced now, and is a bargaining arrangement, it's transactional. Okay, so there will be no common framework, common rules. And this geopolitical shift will actually pretty much hurt mostly the small countries. So small countries can actually, in a common rule framework, can actually prosper pretty well. They can specialize and have the global market for them. And they also played a huge role, or some role, in multilateral organizations. But the multilateral organizations become much less influential because everything is driven by bilateral negotiations, in particular between the large countries and the trading blocs around it. Of course, there will be increased importance from large emerging economies or emerging blocs. There will be more at the center stage, but smaller countries, I think there was a shift away from the influence of smaller countries, and it will be very difficult for them to position themselves. Now, if I compare the pre versus the post world, and I refer to this global resilience paradox, and I want to highlight this in a trade and a finance component. But the pre-arrangement was essentially a sense of mutual interdependencies. And the mutual interdependencies, they create the basis for peace and international stability and allows then at the top layer, they have this multilateral approach, but underneath the foundations was essentially this mutual interdependencies. So we had, just-in-time global value change, and all these arrangements made us interdependent, and we had essentially choke points against each other. So I had some trade choke points against other countries. The other country had choke points against me. And it didn't really matter whether China has 300 choke points to threaten with and the US had 200 choke points. They had a lot of mutual interdependencies. We both could hurt each other a lot. And that actually, this balance of choke points terror, they're referring to Larry Summers' earlier balance of financial terror in the finance world, that actually was the foundation on which all the multilateralism could be built on. So that's essentially why it worked, and nobody really wanted to do much, because you could hurt each other a lot. Particularly from a European perspective, why the thinking was being dependent on Russia, on Russian gas, might actually make it less likely that there will be a move in terms of war against. So that was the thinking. Now we're moving away from such a world, from such a thinking. We move to a world where each country says, I want to be resilient on my own. I want to be autark. I want to have a just in case if something goes bad. I want to have some security buffer, some form of autarky, some self-reliance. But of course, in such a world, you destroy the foundations of the multilateral arrangement. So you minimize the choke points you're exposed to from the other country. So you don't need, some multilateral arrangement, or this is crumbling on itself. And that's what I call this global resilience paradox. Essentially, if every country is resilient on its own, there will be on the global space, there will be no resilience. Okay, the global framework is not stable anymore, because every country said, I don't need the global arrangement, I'm resilient on my own. Of course, it's a much less efficient arrangement, as Philip pointed out. It comes with a huge GDP loss. So global resilience is essentially a common good, and everybody has to invest in this global resilience. By investing in your local or national resilience, you undermine the global resilience framework. Now, in order to understand this threat and counter-threat and these choke points, I want to go in a little bit what I call this choke point analysis 101. What does it mean? When is there a choke point? And, some politicians approached me, yeah, we have these microchips. We really have to, regulate the microchip. Of course, everybody does regulation, but which other products should we actually put on this list of products which we have to watch out for? And then how to conceptually approach that, what products should we put on a list which can be weaponized, and which products are, not of concern. It's a little bit like selective fragmentation. Now, of course, if you think about it, and I want to do this first, let's look at a very simple production function. There's just inputs, and then you produce something, and then later we'll have a production chain, and then at the end I will have a whole input-output matrix arrangement. Okay. So if you think about a very simple production function, you say, no, it's actually all about the elasticity of substitution between inputs of firms. How easily can I substitute one input with another input? So nobody can threaten with a choke point if it's, we can easily substitute one input with another input. So if you do something against it, it's not a big deal. But if it's, elasticity is very low, like with rare earth and other things, then it's actually a problem. So similarly, for a consumer, you can also look at the elasticity of substitution. Of course, there's a time dimension to it. In the sense, the elasticity of substitution in the short run is much lower, so it's more Leontief or Cobb-Douglas rather than perfect substitutes. In the intermediate run and long run, I can actually adjust and find some solutions how to substitute one input for another input. That's what Samuelson called the Le Chatelier principle, where in the long run or in the intermediate run, we can actually learn how to adjust and adapt. And that's this resilience concept, this adjustability and adapting to that. And if things are more flexible, if you're a more flexible economy, you can adjust to this as well. Now, this is if you have a very simple production function. But let's suppose you have a more production chain. And so what I depict here is like you have essentially two layers. So there's a production, and then each production, like here, this EV car has 4 inputs, and there are different elasticity substitutions. These epsilons are these elasticity substitutions between the different inputs. And then you have a second product, and you have also certain inputs, 4 inputs each, and there are 4 products here, each has 4 inputs, and then you combine them together to the final consumption good for the consumers. Now you might say, okay, if it's all about elasticity of substitution, I have to say, wait a minute, once we have a production chain, just looking at the elasticity of substitution is actually not the right thing to do. And you see this very clearly. Let's suppose at the downstream between the epsilon 1, 2, so between, let's say, the EV car and the diesel car, if there's perfect substitutability between an electric car and a diesel car, it doesn't really matter what upstream the elasticity of substitutions are. Let's suppose there's a Leontief arrangement, so the epsilon is 0, upstream, there's epsilon 1s, it doesn't care if there's some rare earth is not suddenly, cannot be substituted for the battery in an EV car, then we just switch all to diesel cars and it's not a big deal. So there's actually no power, no weaponization possible if there are perfect substitutes downstream. So what really matters is essentially, is there some elasticity substitution on the downstream rather than upstream? Okay, so but you have to look through the whole production chain in this sense. So if there's an essential, on the other hand, if there's an essential consumption good, if you're now downstream, if there, let's suppose now instead of taking these two forms of cars, I take one product is an antibiotic medicine, I cannot substitute it with anything, then it doesn't, that's what matters. So the downstream matters much more. The elasticity of substitution downstream matters much more than upstream. Okay. Now, there are, of course, also some products where the upstream still matters if they are essential and universally essential. So what are these things? So microchips enter almost any product these days. So they are universally essential. And it's also the case for earlier, it's still the case for oil in terms of transportation and all this and heating and all this. Oil essentially enters most of the production we have. So even though it's not downstream, it's upstream, but if it's universal across the whole product space, then actually it also matters. It becomes systemic in a sense. So there are also choke points. So there are different forms of choke points. And if you want to answer the question, what product should be put on this list which can be weaponized or can be choke points against us, so let's think about these points. That's what you have to do. Now, this is now for production chain. Of course, the real world is more complicated. And then you have input-output metrics a la Leontief. And then, you have to think, okay, now you have all the elasticities. I just sketch it here. You have all the elasticities here to look about. And of course, you can think about these, and that's, Baquet and Fari worked on that for small shocks. And if everything is linear, you can just scale it up for larger shocks. And here I draw just on a paper by Ian Drew-Becker in Econometrica, where he studied the first order effects of large shocks. Let's suppose huge, suddenly the input is not coming anymore, so it's a large shock, what to look at. And what he shows, and this is just drawing on this paper, I'm not the expert on this, it doesn't really depend on the elasticity substitutions anymore. The exact estimate doesn't matter so much. What really matters whether it's more than one or less than one. Is it, on the one side of Cobb-Douglas or on the other side of Cobb-Douglas? Okay. The links in this network, production network, what not really matters is not the intensity of the links, how thick the links are, but is there a link or not? The existence matters much more. And it's still the case that downstream matters more. So that's still in the sense, but you can still have a relative downstream measure where matter things. And in terms of size of the sectors, you have this, if the size of a sector is larger, there's a shock. How much does it impact GDP? Of course, the larger the size is this famous Hutchins theorem, where you say, okay, the larger the size, the bigger the impact on the GDP. It's not the size in the steady state which matters. It is actually the size in this conditional on the extreme tail scenarios. Okay, so it can be very misleading to just focus on the steady state general size component. That's essentially the main messages from that paper. So the choke points, what to say, now I have all these threat points, these potential weaponizations, what do I do? And the first thing to say, okay, I'm exposed to these choke points, what can I do? And it's different from a risk. Risk is nature is throwing randomly something. An opponent is moving strategically against me. So one way to answer that is, okay, I have all these choke points faced against me. I develop my countermeasures, and I have choke points against my opponent. Okay, so rather than giving up and say, okay, what should I do? I limit everything. I develop my countermeasures. I might be still exposed to some choke points from my opponent, but I have some countermeasures in a sense. And that was essentially the old world order before fragmentation. We just get the balance of these choke points, and out of from this foundation we can then build some common rules in a sense. And that's very similar as I mentioned before. But we moved on from that. Now that is okay, we have to now reshore, bring production capacity back home, or we have to friendshore, and then once you friendshore, you have to say what's the elasticities, the trade elasticities. How easily can I substitute, can something go wrong if a friend is not delivering? Or the alternative then is also multi-sourcing. That's like diversification, and it's not like a risk diversification. Is if I have sources from 3 different countries. So far I had it from China, let's say, now from China, from some parts of Africa and some parts of Latin America. Nobody will threaten then anymore, because I know if something goes wrong, I can go to another continent and source from there. So the initial risk is gone too. It's not a risk, it's a strategic move of the counterparty. And that's already Winston Churchill knew that. There's a famous quote by Winston Churchill with regard to oil. Remember, oil was this universal input. Safety and certainty in oil lie in variety and in variety alone. So essentially that's the multi-sourcing argument. But there's another dimension I can work on that, and that's on the storage side. Okay, there is intertemporal substitution. So far I talked very much across product substitution. I can also do some intertemporal substitution. And so, okay, I have some strategic oil reserves. So now the US is not dependent on oil anymore, but in the olden days, that's, a way. Once you have strategic oil reserves and you can just threaten, if you threaten me, I have something, then the threat will not materialize because you have a countermeasure in place. And it's a resilience instrument, because resilience is, I might be hit, or by strategic move I might be hit. I know I will be hit, but I can react to that. I have the thing how to adapt. I can adapt into my strategic oil reserves. So let me put it in the language of cost efficiency of these measures, risk and resilience management. So cost efficiency essentially means I want to be very cost efficient. I want to exploit the increasing returns to scale. And that's through specialization, via globalization, I can scale up and really exploit the increasing returns to scale. That's exactly the opposite what I want to do because of fragmentation, that is leading to reshoring and friendshoring and all these things. And of course, one way to, reduce the risk from this global dependencies, I can, of course, do some risk diversification. That's where this correlation coefficient is the key thing. I want to do some multi-sourcing. I don't rely only on one. And then it depends what's the correlation of the endogenous response of China. Will this other country I rely in Africa on also respond the same way, or where can I rely and that on? That's a risk management approach. A resilience approach goes beyond that. Essentially says, if something goes wrong in China, can I still rely on the African supply, or can I even scale it up? How does the African respond to that? And how can I adapt? How can I react to that, or the adjustment? And so it's rather than the correlation coefficient, it is the adjustment cost coefficient in model terms. Okay, how can I adjust? What's my elasticity of substitution? That can I scale up after the bad realization? How can I not avoid risk, or through diversification, how can I navigate risk? Once things realize, how can I readjust to that? And that's what I can do once this risk realizes. And ex ante, I can set my system up in a way that I can more easily adjust subsequently. So I have lower adjustment costs. I try to invest in lowering adjustment costs, try to invest in flexibility. Now you might ask, so what? There's a trade tension, of course. In trade, there's this tension. If I want a free globalization, it doesn't go well with industrial policy. If some countries do industrial policy and promote their own industries, and others want free trade, that bites each other. And so what should be the best response, for example, if China does some strategic industrial policy, the emphasis here on strategic, and they follow different economic model, different values. And so there's some proponents that will say, we have to do the same. We have to do industrial policy as well, and close the borders. And I would argue that we should not be so quick. We shouldn't throw out our rule book. We should just fine-tune it and have a more sophisticated response. If China is, exploiting increasing returns to scale and subsidizes certain products enormously, we should say, in most cases, just thank you and buy them, because they're highly subsidized. We get the products more cheaply. For example, in solar panels, if we anyway have to have the green transition, if this is subsidized, it's a good thing to have. But there's some, of course, important exceptions. And that the exceptions are coming back to the choke points I mentioned earlier. In a static thinking, if you're static thinking, say, okay, if there might be potential choke points, even if it's subsidized, I would be, I might be worried about that if I don't have counter choke points. And then I do it on my own, so I have to do, build up some strategic storages, or I develop some production capacity on my own. That's the case, and if it's also when the increasing returns to scale lead to a permanent trade imbalance and things. And that there's also a dynamic perspective. It might be the case that there's no choke point at the moment, but you can foresee if the innovation goes along, it leads to a future choke point down the road, because you lose the innovation leadership in this space. You lose essentially to have your own increasing returns to scale. You lose the potential to have the standard setting. You're not able to set the standards anymore for certain new technologies. In these spaces, you have to be careful. So you just say, oh, it's just saying thank you is not the right thing approach. And then there might be other products for which China has already innovation leadership. And then you could say we do the same thing China did for the last 20, 30 years. If you want to sell these products, you have to do some FDI in the West. And that's a similar way what China did and got all this new technology. So I think it has to be a fine-tuned response on that. Let me say a few words on finance. So far I focused very much on global trade. I want to say a few words about international finance as well. And of course it has implications also for the global safe asset, which is the US Treasury. So Summers made this famous article where he said the balance of financial terror, which balances things, and that works out. So the pre-fragmentation world, and it's also sometimes referred to as Bretton Woods II by Peter Garber and others. China holds a large amount of global safe assets in form of US Treasuries, and the US has a large financial direct investments in China. And this, we can threaten each other, and there's a balance of threatening to each other. We can weaponize, but there's a balance on that. Of course, what we see now is essentially China is getting out of the US Treasuries, or is less engaged in US Treasury investments, much more focused on holding gold and other things, and see generally a tendency between the two blocks emerging, as Philip has shown very clearly, and the US FDI investments in China going down as well. Okay, so that's it. That's just another thing, so this being less able to threaten each other. Finally, I want to show the transition phase, and Philip was emphasizing what the implications in transition phase on inflation. So essentially, you think of our world, we are started out in a pre-fragmentation or in a globalization, a global world order, based on this balance of choke points threats we had. And on this foundation, we could build the multilateral organizations, and then we have a global order with a common framework helping the whole world essentially to do that. But we move to a global, I call it unorder or non-order, let's say. And let's suppose this actually leads to a lower level, and I didn't put numbers on it because Philip has much better numbers on this. The global order GDP level is much lower. You can see this in the blue curve. So there's a transition, there's the old global order, and then there's a fragmented global unorder, and then there's a transition phase. But the way it typically happens is that this doesn't go down smoothly this way. Even though there's a slow transition, measures come one by one, there will be a J-curve effect. There's uncertainty during this time. So there's an overreaction to that, and then in the long run, we might reach the new steady state. Okay, we go from the old steady state to the new steady state. There's a transition, a slow transition, objectively, but actually the GDP itself will actually react much more sharply because of this J-curve effect. Now, what happens if this transition happens fast? And that's where the resilience component comes in. So this system is still, this J-curve effect is not good, but at least it's resilient. In the long run, we come to the new steady state. Now, if this transition happens fast, of course, the J, like in this dashed line, you see the fast reaction to that, to the same potential steady state. But now the J-curve is more pronounced along this dashed line, and you might hit a tipping point, and you might never come back to this theoretical steady state down the road. So that's essentially threaten the resilience as well. And so these resilience aspects, I think, in these transition periods, it's not only resilience bouncing back after a shock or after avoiding a threat, it's also a transition phase, a shift, resilience to a shift, which is a transition phase. And we have many of these transition phases. Of course, we have positive transition phases with artificial intelligence, productivity enhancements. We will also have to manage the resilience of the transition periods. And in the green transition, and there are many of them, the global order moving to a non-order or a fragmented order is essentially another of these transition phases. So let me conclude with this slide. So what I wanted to get across in this geoeconomics and resilience is we have a change in the world order. The old world order, the foundation was built on interdependencies, on having threat points against each other, being able to weaponize each other. That was the foundation of all the multilateral arrangements on the globalization. And we had a balance of choke points. How exactly whether I have 200 choke points on 100 choke points on the other side doesn't really matter. There were a lot of choke points, and that was all building on that. We're moving to a new world. It's all about national resilience. And in that, rather than multilateral, we do bilateral transactional things. Of course, small countries, there will be much more difficult situation because they don't have the same weight compared to playing in the common world order. And if we have a fast transition from the old world order to the new world order, then we can hit some tipping points because the Jacob effect might be too pronounced and you hit the tipping point. Overall, you know, if you want this global resilience is a common good. So everybody has to invest, and typically is underinvestment in it. Well, of course, having a hegemon who cares about that is very, very important. If you don't have this hegemon anymore, it's much more problematic. The way to analyze that, I thought, okay, and from a trade perspective and from a finance perspective. From a trade perspective, I focused on this choke point analysis. And it's quite tricky where to look. If a politician asks you what's the list of products we should really weaponize or we could be weaponized by our opponents, you can't just simply look at the elasticity of substitutions. You have to look along production chains and the production network. And you know, downstream matters much more than upstream. Universal matters much more than other things. So it's a more complicated analysis in this setting. And there's a big time dimension to it as well. You know, if the transition happens slowly, then you can manage it differently. It's much more resilient than if the transition happens very fast. And the question is, you know, after a shock, can you rebuild new links very quickly? Can you substitute this? Can you do something with you know, with storage to smooth things out and things like that. So can you invest in your own adaptability? And what's important is if you're very flexible and very adaptable, then your opponent will not even make an adverse move against you. It's very different from a risk shock, where the risk shock comes with random. Nature is just moving randomly. Opponent is moving strategically, and that's why you need this threat point. And from a finance perspective, there's the same balance of financial terror using, and that has implications, as I mentioned, to the global financial asset as well, the US Treasury, because it becomes a much less attractive thing, except what Maury mentioned. You can, of course, weaponize that too. You get a tariff imposed if you don't buy the US Treasury. But that's a very different way of handling things. Thanks a lot.
I think this session will deserve the title of the dismal science session. We have very dark views on what is going to happen and lots of food for thought and probably action. We will have Q&A session in a moment, but I would like to use my privilege as the moderator to ask a few questions for this distinguished panel. One question I often hear from various people is why we're in this situation. Why do we see this fragmentation happening now and not, say, 10 years ago or 10 years later? Is this Russian aggression, the rise of China, populism, global financial crisis? Well, what is your view on why this is happening now? It's a question for all of you.
Great, I get to start. It's a little bit all of the above. There's a interplay of domestic politics and international politics. So we have had a long period of globalization, which in many respects was immensely successful. If the goal was to restore prosperity after World War II, to aid in economic development in impoverished parts of the world, even to promote global peace to some extent. If you looked at the record up through the collapse of the Berlin Wall up through the early 1990s, it looked pretty good. And in fact, after the 1990s, in the 2000s was when we really began to see more rapid convergence of developing countries to higher levels, and that was also promoted by globalization. At the same time, globalization, together with technological developments, which also contributed greatly to prosperity, led to domestic and international tensions. Whenever you have structural change, changes in the distribution of income, cultural changes associated with globalization, political tensions emerge. They're not new. I mean, if you go back to the 1920s, you can see similar tensions as the world sort of reglobalizes after World War I. But those have come to play a very outsized role in many of the more prosperous countries. At the same time, you see changed geopolitical configurations as different countries rise. If you have the U.S. being a hegemon up until the 1990s, say, even through the first decade of the 2000s, it can provide public goods and internalize much of the benefit of those public goods. As you get into more recent decades, with China vying for global influence, global leadership, those public goods appear, the cost-benefit changes. They're more costly to provide, and the benefits seem smaller as opposed to simply retreating into a more America First posture, which is where we are now. Again, these outcomes are not unprecedented, even if you look back to the, as I alluded to, the late 19th century, the early 20th century, which we thought of as heydays of globalization. You do see globalization backlash emerging in those periods. You do see geopolitical tensions emerging, partly related to imperial rivalry, and ultimately this leads to the disaster of the long period between World War I and World War II, after which the world kind of wakes up. The U.S. is left in this hegemonic position, and we get a really long, 65 or so year stretch of global progress, and now we've entered completely new territory where the outcome, I think, looks very murky. But as I said at the end, in the context of global threats that are much more serious than what we faced 100 years ago.
Markus?
Yeah, that's hard to add many more things. Let me just say, I don't think there's a silver bullet. I don't have a clear answer why it is this way. I would say something, of course, there's a polarization at home, the China shock everybody talked about, even though a lot of these, leading to more inequality aspects was probably driven by new technologies rather than international trade considerations. But the narrative was essentially played of the China shock to a large extent, and that hurt. Then I would say there was a hope which faded away. So through the acceptance of China in the WTO, that China would become more like the West, and the whole world would be like the West, and this hope faded away. And now that all this doesn't work anymore, we had this aim: everybody's becoming like the West, and same democracies, but it didn't move this way. This moved differently. Hence, there was a rethinking on that as well. And probably we'll live also with new technologies with much more uncertainties, and people like to have some more comfort going back to the old days. So there's a lot of thinking, so at least in the West, we don't look forward what the progress is and what the advantage could be. So more thinking, let's go back to the olden days. And this might also contribute to that. But this is all purely speculation. I don't have a clear answer, I have to admit.
Maybe from a European perspective, it's worth adding a few comments, but fundamentally, a lot of what Maurice said, I think, is the most basic narrative, the most fundamental narrative. But if I think about Europe, first of all, I'm not seeing in Europe any major discussion that we should become more closed. And I think I did mention Brexit, but I think the European Union is a bundle, and for the UK to kind of, in the phrase, take back control over immigration policy, they couldn't pick and choose. So they had to also give up the single market. But I don't think that was the reason why the Brexit vote happened was a desire to have a more restricted trade. It was an issue about migration. So there's definitely a big migration debate in Europe, but I don't think there's a major push towards protectionism. And so there is an open question here about American exceptionalism. I mean, what is it about the US that is, and maybe again I've just answered it, going back to how Maury phrased about going back 100 years or more than 100 years in terms of, I mean, American can think about isolationism, they can think about exceptionalism, they can think about somehow that maybe economic levers will alter political choices elsewhere. So I would say maybe rather than make it a universal question, Yuriy, it's really a question I would more think about here. But I would say looking at Europe, but maybe it's true here as well. I mean, another way of reading the chart that Maury showed about the kind of trend down in manufacturing employment is the amount of people who are directly exposed to world trade is obviously trending down. More and more people work in the services sector. Now, they may be super affected by world trade, but through various input-output matrices that they may not be immediately obvious to them. And so people may say, okay, I can live with less globalization because it's not so obvious maybe in some cases. But that's me just becoming an amateur sociologist. So, yeah.
While the audience is thinking about their questions, I'll ask one more question. Markus mentioned the balance of terror or financial terror, and I guess as a student of the Cold War, I learned this lesson that if you remove the balance, you have only terror. And I'm not sure what exactly is going to happen in the arena of finance and economics if you remove the balance. Do we have just choke points? But it seems like it's not really a credible threat if you can just hurt yourself and not everybody else. But I want to reflect this panel on the role of the dollar and the euro in kind of maintaining this global order, multilateralism, and what may happen if we have fragmentation. Is the dollar going to lose its prominence? Is the euro going to also degrade its status as a reserve currency and so on? What are your views on this? Maybe we can start with Philip, since I had a question about the euro.
So here, I'm not sure if very developed answers, but probably when you think about analytically, it's important to try and differentiate between stocks and flows, for example. Because, of course, there's a whole debate about the flow of payments. How do payments get made? What is the kind of choke point? What are the choke points? For example, we had this issue with SWIFT and so on. But it looks like there's many ways to make a payment. So the ability with some time to create alternative payment systems and so on seems quite high. In terms of stocks, and of course, I worked quite a bit on cross holdings, who owns what around the world and who owes what to whom. There's definitely a kind of matrix of exposures there, but it's not so easy to untangle. But what I would say, and let me come back to our own work, definitely having the autonomy in terms of being able to run your financial system is important. I mean, that's a basic kind of expression of sovereignty. And this is where, I mean, the euro area is a euro-denominated financial system. We are not particularly dollarized. People sell to us in euro. We export in euro. The domestic transactions are in euro. So I think I often, say, well, this may not have been a part of the issue 25 years ago when the euro was created, or 30 years ago when the euro. The counterfactual of having a Europe with 19 extra currencies, I think just goes back to underline at some point the kind of value of having a financial system that is big enough to be autonomous is important. And that is an important, conviction about the euro. It's in the world we live in, having the ability to run your financial system in your own currency is a valuable type of resilience, I would say.
Yeah, let me say a few words on the dollar and the euro as well. So what I can see in the short run, essentially given now with the new administration, is that the dollar will actually gain some prominence due to new digital currencies. So while, the current old administration was very hostile towards stable coins and other currencies, digital forms of currencies, the new one has a very different attitude, and there's a way more impact from Silicon Valley on these matters. So you will see a lot of digital currencies coming up. Most of them will be pegged will be stable coins with respect to the US dollar, and there will be more prominence on that. The counter reaction will be that many smaller countries will probably fear some threat from being dollarized. Less so, I think, Europe, but to some extent also Europe. And there will be a revival, that's at least my bold prediction, of CBDCs. While CBDCs was a huge wave going on, while Facebook and through Libra and Diem tried to establish a separate currency, it calmed down, and everybody said, let's slow down on the CBDCs. I think this will come back because now there will be way more dollar stable coins coming for. And there will be on top of it, be also a lot of payments going on from AI agent to AI agents. And these payments will also, be transacted mostly in form of the stable coins. And there will be a threat, and many countries will be fearing a threat, and that's probably will be a countermeasure. And that also with respect to the digital euro and all this. So I think there will be a revival on that dimension. In this sense, I'm not seeing the short run, at least I don't see the dollar going away, but it will be a shift away from the official currency, creating seigniorage for the US government rather than creating some initial coin offerings and other private stable coins, making a big inroad into that.
Yeah, I agree with what my co-panelists have said. Let me sort of expand a little bit on it. I think there's no alternative to the dollar as a true global currency, but I think there is a chance that with sufficient mismanagement, other competitors could arise on a regional basis as countries try to insulate themselves from the U.S. And at some level, the euro already is this sort of regional currency bloc that is certainly connected intimately with the dollar bloc, but that could actually function on its own if need be. The incoming administration has expressed a wide view of very contradictory policies with respect to the dollar's global position. The 2024 Republican platform included keeping the dollar as the world's premier global currency, President-elect Trump has said he wants to do that. But on the other hand, there's talk about weakening the dollar, which again, the incoming Treasury Secretary says is not inconsistent with preserving the dollar's role. I think that depends a lot on how weakening comes about. There's also a narrative which is expressed, for example, in the document I cited by the incoming CEA chair, that the root cause of the U.S. trade deficits is the dollar's reserve currency role. This is totally erroneous, but one of the policies he suggests is that the U.S. should tax the official international reserves of foreign official holders of dollars, which of course would not accomplish anything because they can hold dollars in ways that don't go through the U.S. Treasury market, and they will, and they have in the past. And this is actually how the euro dollar market came into being. Soviet Union did not want to hold its dollar reserves in U.S. banks because they could be sanctioned. The other respect in which the messaging from the administration is contradictory. Oh, I would add to this that the Vice President-elect has also questioned the dollar's reserve currency role as something that is negative for the U.S. trade balance and for U.S. manufacturing. The other issue is connected to the issues Markus raised of digital currencies. There is a narrative among, if not members of the new administration, fellow travelers, that the dollar has been a very unstable currency, and that as a result, the U.S. really has to promote not necessarily stable coins, but Bitcoin in particular. And of course, any cursory glance at the stability of Bitcoin would lead you to question whether it's indeed more stable than the dollar. But this sort of rhetoric is very damaging to the dollar's international role. There are serious proposals in Congress to set up a strategic Bitcoin reserve of 1 million Bitcoins. The U.S. government already owns around 200,000 that it seized from illicit actors. But the idea here is that, this is a great hedge for the U.S. balance sheet, and it's much more stable than the dollar. And I think that ultimately is contradictory to the message that the U.S. is serious about preserving the dollar's global role. So I think we are in for some turbulence in the balance of financial terror as the administration pursues these initiatives. And the Bitcoin reserve, if you think it's crazy, there's a bill in the Pennsylvania State House now to set up a state Bitcoin reserve, which seems to be advancing. So it's not just El Salvador that's pursuing this. It's not just banana republics.
Thank you. If there is a question from the floor, please raise your hand. And when you ask your question, try to be brief and also say your name and affiliation. Yes, please.
A.P. Braun, University of Texas at Austin. The one counterexample to the guns versus butter trade-off that I seem to see is 1945, where the U.S. economy was the only one that came out stronger than it was in 1939. That was probably a unique set of circumstances, but the question is, can we learn anything from that experience?
Don't go too far with the mic. Yes, one more question.
Andrea Presbitero, IMF. Thank you very much for the very nice discussion. I would like to hear, if you can, from the panelists about something about the implication for emerging markets. There is a lot of, especially the large one, there is a lot of discussion about trade diversion, investment diversion. Some countries may benefit from it, and the extent to which, especially I'm speaking to what Philip Lane showed, like the 3 blocks world, the extent to which do you think such a sort of equilibrium is sustainable, or if some of those countries have to end up taking side and going one way or the other? Thank you.
Any more questions? Here.
Brunnermeier, University of Texas at Dallas. Is there a tension between environmental protection and, for instance, mining of crucial commodities like lithium, copper, and how does this in particular affect the European Union that cares about these things a lot?
Thank you. Let's answer those questions and then collect some more.
I've got this. Let me just sort of try to address the first question a bit. Of course, the U.S. ran a wartime economy in 1945. That was economically costly in the short run. There was a war to fight, so it wasn't a question of there was an immediate danger, and in the process, the U.S. did emerge as indisputably the world hegemonic leader. But the lesson it took from the experience, the economic and political experience of the interwar period that led to that war, was that the world needed a more cooperative framework that would promote recovery and global prosperity. And so, in some sense, the U.S. actually invested in reconstruction in Europe, in Japan. There was, you can say that at some level this was negative guns and butter. That the idea was to sacrifice economically to build prosperity elsewhere. I think the other aspect of the World War II experience that I think contradicts the guns and butter narrative is a unintended positive consequence, that an incredible number of technological advances came out of the investments in the wartime defense industry and in surveillance technology, other technologies that were initially used for military purposes, but they were dual use. Not in the sense that civilian uses could be put to military use, but in the sense that military uses could find civilian applications. So that was an unexpected but very favorable outcome. I wouldn't expect that necessarily in the current environment where the U.S. economy has been quite efficient at creating technological advances. If it now sparks a global trade war, will that help the advancement of technology throughout the globe? I don't think it will.
Thanks. Let me address briefly all three questions. So the first one is, of course, the US was coming out as the winner in 1945 because the war didn't happen in the United States. It happened in Europe, so nothing was destroyed. And one could also argue that the World War II expenditures was the fiscal stimulus needed to overcome the Great Depression, so that also helped out. And finally, as what Bruce Greenwald always puts forward, is that there was a huge transition going on where most of the workforce lived on the countryside, then they had to go to fight in the war and come back to the cities. So this transition from moving from the countryside to a more urban arrangement where they live in cities, this transition was difficult to get started and get going, and the war helped to speed these things up. And all of these reasons actually strengthened and then led subsequently to higher productivity growth in the United States. On the second question about the implications for the emerging economies, emerging markets, whether they have to take sides, to some extent they will probably be forced to take sides. Probably it also depends on proximity to various blocks. The main implication for me would be that in general, I think it is not helpful for them. So far, the globalization really worked marvelous for the emerging economies to get lots of billions of people out of poverty. Whether this will keep going on is questionable for two reasons. One, China is of course producing everything, so it has to move much to a service arrangement, so for other big countries. But the bigger shift will be between small and larger emerging economies. And whether the smaller emerging economies, how they will handle it, their influence will actually go down. If you're still a large bloc, then actually you might be able to navigate the situation, but for smaller countries it will be more challenging. On the environmental protection question, so far, essentially, many of the Western countries try to influence environmental regulation through, globalization. In a global environment, you can impact the environmental regulation also beyond. That will be less the case once globalization is scaled back. And of course, I should also say that, of course, the Global South is not very happy that the North is imposing certain environmental regulation on them by saying, okay, you can only sell your products if you satisfy the following environmental standards. That's extraterritorial implications. There are a lot of these implications, and that led to a lot of animosities of the Global South towards the West, and also a reason why, for example, the Global South is not supporting the war in Ukraine as much as we all hoped for. And so that's something which, one has to take into account as well. In general, I think it makes, given that a lot of these environmental issues are global issues, if globalization and multilateralism is scaled back, it makes solving these problems, as Maury mentioned earlier, much more challenging as well.
So I think it's maybe interesting with the emerging markets and developing countries. Maybe I think about Europe. I mean, we're surrounded. Africa is a very big neighbor to us, and maybe one of the issues. What's interesting is that essentially now I would say there's a lot more interest, both from a European perspective, but also at least under the current administration in the US, there's been a lot more interest in basically being not leaving Africa just to Chinese, investment and incentives. So this paradoxically maybe the kind of competitive pressure is leading to more attention. But Maury put up the list of levers, if you like, or questions that maybe the new Trump administration might use, which is a side-taking type of set of criteria, which would be a concern. On the green transition, of course, you always have to think about the counterfactual. And, if behind the question is, well, of course, we could decarbonize more quickly if we scale down our kind of economic activity and just kind of use less energy in general. But if the counterfactual is a kind of slower decarbonization path, if decarbonization means indeed having to mine new sources of rare earths and other essential inputs, I'm fairly sure, given the way Europe operates, all of that will be within the framework of a sustainability analysis, and also at the global level, with measures such as the carbon border, adjustment tax and so on. There is a desire to have a kind of coherence between environmental policy and economic policy. But again, the counterfactual always matters in thinking about that.
Thank you. We have a bit of time to more questions. Yes, please. Please remember to say your name and affiliation.
Thank you. Rado Gabudin with American Century Investments. Taking this framework to implications for the asset markets. Globalization made U.S. asset markets, U.S. stock market and treasuries and so on, the biggest asset markets in the whole world, and very powerful. Do we see now going towards a more fragmented setup? So as an investor, Do you have to think a lot harder where else you need to go? You have to access asset markets in Brazil or in Russia, which you cannot, or in China or other places. Does that make sense?
More questions? Yes.
Yuriy from the IMF. Thank you very much for the very interesting panel. Two questions. One, going back to the Hirschman's book that Maury put up. So my memory of old reading of that book was to teach that economics alone may not quite give the full answer, especially in trade issues. Now it seems to be, I guess we just knew about it all along when we said that it used to be called political economy. But is it about time for us to get more serious about bringing in political elements into the analysis, if possible even formally? For example, that guns and butter trade-off. If there is a utility for a country being a very influential existence, can that even alter trade-off, something to that effect? On CBDC, what about the challenge of managing the international flow among CBDCs? There are some proposals floated by BIS and the like. All seems to be extremely complex. What will be the prospect of that taking off in international dimension? Thank you.
Thank you. I will throw in one more question. We emphasized a lot all sorts of disruptions between countries, but one question I hear often from various commentators and I guess the general public is we have internal disruptions in Europe, in the US, for example, the prospect of mass deportations in the US, tariffs, all of this suggests that prices are going to potentially increase quite a bit in the US, and this may force the Federal Reserve System to keep interest rates high for much longer. And one question is how in this maybe more fragmented world, this kind of policies, US monetary policy, is going to transmit to the rest of the world. I can see who has a microphone. Philip, do you want to start?
So just going back to the question about the headache facing asset managers in this world. I'm not going to try and provide a universal answer here, but I mean, what I would say, just from if you look at the charts I showed, is that I suppose geopolitical risk is something that needs to be priced. That you can see already it's affecting trade flows, I'm sure FDI flows, I'm sure the value of firms. So there's kind of this distinction, and we had in our financial stability report earlier, in the May 24, there's quite a nice analysis of geopolitical risk and financial stability. So hopefully most of the time we have risk discussions, much less often converting into events where they actually make a decision, which is a long-term consequence. So yes, maybe hire more political scientists. But one of the interesting issues is trying to predict. As a central banker, we don't really have to predict because we meet every 6 weeks, so we can always kind of adjust as we go along. But if you're trying to value a bond or a stock, you do need to kind of predict the future. And this is really an open question about, because these are very rare events. It's very rare that the trade policy gets moved. And this is why we've been spending this panel talking about 100 years ago, 150 years ago, and so on. There's not too many data points to work on, which I think probably makes it interesting. Yuriy talked about the transmission of monetary policy. What I would say, two things. One is in terms of, again, fundamentally, if you think in terms of the real economy, it's going to be less elastic. Essentially, if you don't have access to the world's supply chain, domestic demand shocks will lead to more movements in marginal costs and inflation pressures. So I would say, with trade fragmentation, it probably leads to more volatility. Financial fragmentation also, I think, will matter, for example, in terms of the contributors to the term premium. Because, of course, a lot of time when we're thinking about, well, how's the world responding to the policy rate? So whether the Fed's policy rate, our policy rate, of course, for overall financial conditions, other factors influencing term premia come into that. And that does go back to what Maury talked about earlier on. How the world's investors, their attitude to duration risk in this world. Because if I'm buying a 10-year bond, which is going to be exposed to many decisions over the next 10 years, my attitude is very different in a world where there's a lot more event uncertainty than under a much more stable world.
Yeah, thanks a lot. So in terms of asset markets, it's hard to add much more. I agree that the geopolitical risk has to be priced. What's also interesting is that geopolitical risk is self-fulfilling in a sense that, it can be spiraling out of control. So if everything might look very calm, and if there's nothing materialized. But if it materializes, it becomes typically a big thing. So that's one thing. And if you then look within an asset class, what stocks to focus on, then I think you can do this choke point analysis. Say, okay, these stocks might be affected much more or not. And also, you probably want to look at certain companies which are more nimble and adaptable and are more resilient to the changing environment. So rather than saying, okay, I look at companies which are, have a hard time to adjust to potential shifts in the environment, you evaluate and price and put in your pricing in the nimbleness and the ability to move. With regard to, I can also see, so what we also saw in the last few decades is that the interest rate policies across the different blocks moved pretty much hand in hand. So there was not so much pressure on the exchange rate. I can see many more pressures on the exchange rate moving around as different measures will impact different parts of the world differently, and hence interest rate policy might not be so similar across the blocks. With regard to the second question, I agree that political analysis should be part of any economic analysis. Well, we have to develop a framework on this, and that's essentially having, what's a new framework, how to think about trade policy more generally, and also financial policy in this changed world, and how the geopolitical aspects and the traditional economic aspects interact, I think is very important. With regard to CBDC, yes, so moving from one CBDC to another CBDC can be complex. My understanding is that the BIS is working very much on it in order to simplify that, and it's also the private sector somehow gets involved in these international transactions, how they arrange it. And of course, there are always institutional constraints, what you can do, but I'm hopeful there will be something. And then Yuriy's question about internal disruptions going on. So I think the fact that the interest rate is higher, that will be costly. So in the olden days, we always said, oh my God, the interest rate is too low, secular stagnation, that's so bad. Now the interest rate is higher and we have to pay it in higher because we have such a huge amount of debt and we have to pay the debt. So the whole issue of fiscal debt sustainability, which didn't come up, I think is a huge issue we have to think about, in particular if the interest rate were to stay higher and if the growth rate is not coming along with that. So that's something I think which we can devote a whole panel on it as well. Thank you.
Yeah, just going somewhat in reverse order, I agree with Markus's point about U.S. fiscal sustainability. I mean, we'll see how the budget evolves, but there could be a point where term premia rise significantly and borrowing costs rise significantly, and that would have implications for not only the dollar's role, but for the entire world economy. So we'll see how that develops. On the political economy and trade point, there is actually, a growing field of geoeconomics that, the CEPR has a geoeconomics program. And in fact, I believe at 10:15, there's a session probably over at the Hilton on geoeconomics where you can go sample some of the latest theoretical and empirical research. So I would recommend that as a better answer than I can give. The CBDC discussion is very, very interesting. My impression is that the BIS has temporarily at least suspended its discussion of building a global cross-border payment system based on CBDCs, and that reflects to some degree political tensions. For example, it's hard to see how you have a fully integrated system when you have strong geopolitical tensions and concerns about security and surveillance. There are limited examples of very close cooperation in cross-border payments, such as between Singapore and Thailand have set up a system, but a universal system seems to me to be out of reach for the moment. And finally, asset segmentation. I think it's notable that we've seen a lot of discussion of tariffs, which are taxes on trade, but not a lot of discussion of tariffs on international capital movements, which is a little puzzling in view of the fact that the trade balances that we worry so much about, the trade deficits, are matched by capital account surpluses. There was actually a bill put forward in the Senate in 2019 by Senators Hawley and Baldwin. And when your far left and far right senators agree on an economic policy, you probably should worry about it. But their proposal was that, I kid you not, that there be a tax on international capital inflows that would target a certain low level of the US trade deficit, and it would be managed by the Federal Reserve. So I'll just leave you with that thought.
Okay, thank you. We're out of time. Please join me in thanking this wonderful panelists for their insights.